We've seen huge changes in the way people invest over the last 25 years or so. Investors everywhere have been moving away from active money management and choosing instead to invest for the long term in cheaper and more efficient index funds. Someone who's made a major contribution to this shift in investor behavior is Mark Hebner. Mark is a hugely successful entrepreneur who was a self-made multimillionaire by the age of 32. He's the founder of Index Fund Advisors based in Irvine, California. And he's the author of the award-winning book, Index Funds, the 12-step recovery program for active investors. So how did Mark's interest in investing begin? What led him to found his own advice firm? And why are investors so much better off using index funds? Mark Hebner joins us now. Mark, you founded Index Fund Advisors in 1999, but the story began before that. What happened?
For me, the beginning had to do with the sale of my publicly traded firm way back in 1985. I was 32 years old, and I had a very large windfall for my age. In fact, Steve Jobs and I both sold out the same year. We ended up with the same stockbroker and got a similar amount of money. He obviously had a lot more stock and grew a lot more over time. So I was very fortunate. And I went from being the CEO of a publicly traded firm and didn't take my responsibility seriously to become a good steward of my financial capital. And instead, I was cold called from a broker who saw that I sold, flew down and met with me from San Francisco and convinced me to become a client of his. And over many, many years, 12, 13 years, he kind of bought this and sold that, and I really didn't pay much attention to what was going on, and literally had no knowledge of the proper way to invest.
So you worked with this broker for about 12 years, and then around 1997, you started to learn about investing for yourself. Why was that?
A friend of mine was actually killed in a car wreck. And a few years later, the widow called me up and asked if I could help her with her investments. So I felt an obligation to her, number one, but I also realized that I really didn't know what was going on with my own investments. And I thought, you know what, this is a great opportunity for me to take some time to read some books, to do some research, and see how the market works. And I was literally floored, shocked, astounded, and even angry when I figured out that all of this stock selection and market timing was all a bunch of nonsense and resulted in investors earning far less than they would have if they just diversified their holdings, kept the costs low, kept the taxes low, and didn't engage in a beat the market type of attitude. The realization that you can do really well just by accepting the market return was this light bulb aha moment that was literally just astounding to me.
Tell me more about your learning process. What sort of books did you read?
So I go to Barnes & Nobles and I come out of there with 22 books and I take them home and I start plowing through them. There were many of the early books written about indexing or passive investing, whatever you want to call it. There were some other books in there about actively managing your portfolio as well. One of the things that that caught my attention early on was the fact that all the passive investing had this academic evidence associated with it. There were academics telling you this. And in fact, they were Nobel Prize winners, okay? And I'm going, wait a minute, that carries so much more weight than something I read in Fortune magazine or the Wall Street Journal to have a peer-reviewed academic paper. This is like totally different than reading somebody's, gut reaction to, what Cisco or Apple or somebody's going to do, or some firm is going to do tomorrow in the stock market. And that was definitely an epiphany for me.
Okay, you had this epiphany, and then you investigated the investment returns that you yourself had achieved acting on the advice of your broker. How had your portfolio performed?
This is a little complicated. There's a thing we call an opportunity cost. So had he invested in a portfolio of index funds over this 12 or 13 years, I would have ended up with 30 million more dollars. So you can characterize that any way you want, but had I known what I know now, I probably would have had far more assets than I do at the moment.
Looking back, why didn't you suspect sooner than you did that the advice your broker was giving you was costing you so much money?
I think, like many people who sell things, their goal is to develop a personal relationship with you so that it's harder and harder for you to want to leave, right? And we were in a situation where at least 3 or 4 times a week, we would be on the phone and the conversation would be first, do you want to buy some oil stocks today? Or maybe we should buy some gold. We should do this or do that. And I say, oh, okay, yeah, that sounds good. And then how's your family and how's your kids and, the whole 9 yards. And so you develop this kind of personal relationship. And in the meantime, what you don't realize is you're not investing your assets properly. It's funny, I don't really hold this against them. I'm not saying that he's a bad person, but he was in a system and a business model that required him to do that so he could make an income and so the firm could make an income. This industry, 99% of it is designed to get people to trade. It's a commission transactional business, and there's a long list of people who are just waiting for that salesperson to initiate the trade so everybody can take a little piece of that trade. And that's what this industry is all about. The big gambling casino. It's the largest casino, really, in the world.
So you're saying that for 12 years you just weren't aware that you could have been doing so much better by simply investing in index funds?
No, I wasn't. This is the crazy thing. I just assumed he was doing the best that could be done. He was in this huge office tower, in downtown San Francisco. How could they not know what's best for me? That's what I thought. So the irony of all this is just unbelievable. So somebody did ask me somewhere along the line in my process, have you ever benchmarked your returns? I said, well, what's that about? No, I don't really know how to do that. And it was the internet in 1997, probably 98, I was doing this, where you could literally go on and draw the chart of the growth of the S&P 500, and then you can look at your portfolio. And I started looking at these gaps, and I'm going, what the heck? I wrote a 20-page letter with charts and graphs to this guy because I felt so bad. We were breaking up, Breaking up is hard to do, even in the brokerage industry. And so I wrote him this long letter and said, I'm sorry, I'm moving my money to a passive investment kind of strategy, and I really don't need you anymore.
Now, it was around this time that you had this idea to start your own financial advice firm to stop other people making the same mistakes that you had. How did that come about?
I talked to some of my buddies, and they didn't get this either. In fact, I don't know that I've spoken to any individuals who really had a good knowledge of really the advice that we provide clients. And I knew a lot of high net worth individuals, and they were in a similar situation with me, relying on a broker to move money around for them and not taking any responsibility on their own or hiring an independent fiduciary advisor to advise them. Those are really important words there. You want somebody who's independent of any product, so you're actually, the advisor's working for the client, not working for the product, right? Or working for the big brokerage firm who wants you to churn for them. And this fiduciary concept is also really crucial. It's a legal concept where you have to act in the best interest of the other party. And we're held to that standard as a registered investment advisor. So when I saw these concepts and learned about them, I thought, wow, I think there's a really interesting business here in both doing the right thing for the client, but also providing a online version of this education. So literally everybody in the world could see it. And I used to love the fact that I would upload a page and I would literally publish it to the world. Boom, like that. And people just started flocking to my website, and all of a sudden the phone started ringing. It was beautiful.
Mark, I'm curious to know what your broker said when you confronted him with the evidence and the hard data that he'd been letting you down. How did he react?
You know, that's funny. I don't recall, but I don't think he had a word to say about it. I think he just kind of said, well, you know, if that's what you want to do, go ahead. He did not put up an argument. Here's the funny thing. I think, especially today, but even then, I think most of these guys and gals in that business had an inkling that they weren't really doing better than the benchmarks. I mean, this data goes way back. And so the word was sort of creeping out about all of this. And in fact, the first index fund was right there in San Francisco where my guy was. So I think there was always even a little sneaking suspicion on their part that they weren't doing as good as they could.
Do you think your broker was deceiving himself? Did he genuinely think that he was somehow adding value? Or was he deliberately deceiving you?
Well, like I said, I wouldn't want to put them in that category. It was the job they were hired to do, and it was the training that they were given. And that's how they made money. They had payments to make too. They got a house payment, a car payment. If they're not trading, they're not making money. It's hard to teach a man something that he gets paid a small fortune not to understand.
Perhaps your broker enjoyed the buzz of trading. The premise of your book, Index Funds, the 12-Step Recovery Program for Active Investors, is that trading is a form of gambling and gambling is addictive. Perhaps you could elaborate on that.
I always assumed, once I figured this out, that there was a little bit of a gambling addiction that sort of gripped a lot of these traders and brokers. And so as clients, we were enabling them to be addicted gamblers, you know? And I do think that's actually the case. You know, that stock market gambling is clearly an addictive behavior. There's two therapists that I've run into who specialize in treating gamblers in the stock market. And the same high you get when you roll the dice or, you know, spin the roulette wheel is similar to the placing of a buy or a sell trade. They call it action in Gamblers Anonymous. You get an action high, you know, from these activities. And that was one of my realizations before I wrote my book. I thought, I'd studied so much about this, and I thought, with all this evidence, why do people continue to do this? I went to Yahoo. There was no Google at the time. I went to Yahoo and I typed in, you know, gambling in the stock market. Well, it took me to the New Jersey Alcoholics Anonymous website where they had a tab for stock market gamblers. I clicked it. And they had a list of things, you know, as to whether you might be addicted to stock market gambling. You know, how often do you check your portfolio? You know, and all these questions, they had a little questionnaire. And they actually have a pamphlet, which I keep in my office, and I slide across the conference room table to people who come in, and they sound like they have a gambling problem. It's just one more element to sort of the psychological behavior that affects investors that I felt was really important that people understand that is actually a possibility, that you might have a little too much fun or you might be getting a little too much excitement from your trading. And maybe that's a sign that something's not quite right here.
So you described how you learned for yourself that active trading is a bad idea. What I find really interesting, Mark, is how successful self-made people like yourself often struggle with this concept more than most of us.
I just expand on that a little bit, is that when I get a client in my office who's got $5 or $10 million, I'm in their seat. I know what their life is like, especially if they're living out of that portfolio. I did that for many, many years. As a CEO of a publicly traded firm, you don't necessarily jump right into another CEO job, especially because I was doing radioactive pharmaceuticals. I was operating nuclear pharmacies, right? Well, we were the only publicly traded firm that did that. So it's not like I can go get another job right away. And so I did all kinds of different investments and several businesses actually before I ended up doing this. But I lived a life where I had to rely on my portfolio, my capital, to support me. And that's what a lot of my clients do.
Let's go back then to the late 1990s. You were explaining how this epiphany you had about investing set you off thinking about starting your own firm. Explain how that idea began to take shape.
So the more I read, the more and more confident I became in this. So first moved my own money, and then I got the idea of starting my own firm. I did investments in a lot of internet startups in 1998, 1999, when everything was going crazy in the internet space. And so I learned a lot about how the internet worked, what types of businesses could work on the internet and which ones wouldn't, and to put out dynamic, interactive data and information and charts, and even my artwork that I've created for my book and for my movies, to put all of that stuff out on the web and literally publish it was a little bit of a moment for me, an aha moment, to see that I could get to a lot of people with high quality information very quickly. And if I was competing with other registered investment advisors, there was nobody out there doing this. And so all of those, I thought, led to an interesting business opportunity.
Another key development for you around this time was discovering dimensional fund advisors. Tell me about that.
So in one of those 22 books, somebody mentioned this firm, Dimensional Fund Advisors, that really preferred to work with institutional clients, but would work with a select group of advisors who then could bring their clients, the advisor's clients, and invest with Dimensional. I thought that was interesting, first of all. What is this, select group, and why would they even limit, the clients that could come to them? But I quickly figured out that bad investor behavior was detrimental to the running of a mutual fund. It created a lot of unnecessary transactions in the fund. They only wanted investors who fully understood their investment principles, which almost all came from the University of Chicago, all rooted in this academic research that I had learned so much about. And all of that really clicked with me. And I was driving from Newport Beach to Ojai one day, and to go to a meeting in Ojai, and I left plenty early. Any of you who have driven around in LA, you know there's a high standard deviation around the mean time to get to your location. So I left really early, and all of a sudden there was no traffic, right? And so I'm about to Santa Monica, and I said, I think that Dimensional Fund firm is there. I said, let me check. I pulled over and I got the address, and so I ended up going to Dimensional's office on my way to Ojai, and I pounded on the door to get in, and it was locked. Okay, well, this is kind of a legend that Dimensional had locked their doors because they didn't want to sell to the public. They were only dealing with these large institutional clients, right? So a receptionist finally comes over with a key, and she lets me in. And I told her, I was there to learn more about their product. And one of the guys came from the back and took me back to his office. And I'll never forget, he started pulling paper out of his printer. You know, you open the drawer on your printer to pull paper out, right? And started drawing bell-shaped curves and, teaching me about sort of the science of investing. And I was just like blown away. I said, this is what people have to hear about. And then I started looking at Dimensional's marketing. They did not have a brochure. There was like nothing. And I'm kind of a marketing guy, and I thought, aha, here's another interesting opportunity, is I can use my creativity and figure out a way to teach the world about this in my own way, but with the underpinnings of all of their product research and scientific research and academic research. So when I arrived to Ojai, it was a business group meeting. I made the announcement to a group of fellow CEOs that I have decided to start my registered investment advisory firm, because on the way up here, I met with this really interesting mutual fund company, and I'm going to do this. Boom.
Dimensional really are very different to other fund management companies, aren't they? For example, they only allow advisors to use their products when they fully understand them.
You don't really get approved to use their product until you go to a conference, and you basically go through a couple days of lectures, and they have one of their representatives who kind of talk with you and meet with you along the way. And they don't really want you advising clients to buy their funds unless you really understand the whole buy and hold passive investing concepts and strategy. So you kind of have to go through a test, if you will, by appearing at these conferences. You got to pay your own way to go there, which is also unusual in the business. Most people pay for you to show up and, take you to all these crazy shows and games and whatever, and basically are bribing you in a sense to become a client of theirs. They did none of that, And so it was really very different than the industry. And I found it very refreshing, especially when the professors came in and never even mentioned products. They're giving a lecture like they do at the University of Chicago.
Mark, you've shown great faith in Dimensional's investment philosophy over the years and in the academic evidence that underpins it. Why do you find the DFA approach so convincing?
You use the word faith. I am opposed to using the word believe or faith. I don't want people to think of this like kind of a religious movement. We're often criticized of that. A lot of the industry says that these advisors come to these Dimensional conferences and drink the Kool-Aid, okay? I tell everybody it's just the opposite. We're coming here to avoid a leap of faith that people normally put in these stock market gurus, all right? That somebody has this incredible foresight and ability to see the future and tell you where your money should be so that you're positioned to really benefit for when their forecasts actually arrive, right? That's the essence of our industry. They make a forecast and they place a bet. So what I like to tell people is you either understand this or you don't. And if you don't understand it, give me another half hour and I'm going to help you. I don't want you to take a leap, and I don't even want you just to trust me, okay? I want to teach you so that you have full confidence in this investment strategy, and so that you will be a better investor and won't let your emotions override your knowledge or what you've been taught. So we want evidence before we make these decisions. We don't want to just make them on some gut or some gut feel or some faith, I ban the word believe in my office. My advisors aren't allowed to say, I believe this is going to happen, or I believe this is to be the case, or I believe you should do this. I said, show the client why this is the case. Show them the data and let them develop their own confidence in the data. I said, we're not here to convert people to be one religion or another.
Now, I'd like to play devil's advocate for a moment. You clearly place huge importance on data. You have hundreds of charts on your website and in your book that explain the significance of that data. But data can be very misleading. What makes your data so reliable?
What you're asking is really fundamental to academic research. Can you statistically validate your conclusions so that the reader of your paper or whatever conclusions you have made is confident that your results weren't a chance result or even mined from the data? And one way they do that is what's called an out-of-sample test. So you have a sample of data, and you determine that small and value stocks had higher returns, from 1926 to 1962, right? And you come up with all these conclusions and write your paper, and everybody thinks you're a star. But the smart academic says, well, let's see how it does from 62 to 96, when it's a period that you didn't research, okay? It's called out of sample. You got a sample period and you have an out of sample period. And that is one of the real acid tests that the conclusions you came up with held up in another set of data. There's also a T statistic, which is a statistical significance test that sorts out your conclusions as to whether they were a chance outcome or what's often called a systematic outcome. And so I actually have some nice little charts and graphs that sort out these differences and demonstrate to people that the past winners in terms of managers beating the market were just a chance or lucky outcome because they didn't pass the statistical significance test.
This is a really important point. We hear all the time about active managers who appear to have performed well, but there are so many funds to choose from at any one time that there are bound to be short-term winners simply by the law of averages. How can we tell whether a particular fund manager is genuinely skillful?
There's three elements to that. It's, by how much did they beat the market? Let's say 2% a year. But the one that's hardly looked at is they call that excess return over the market the alpha, okay? So that 2% is an alpha. What people don't pay attention to, and you don't see it in Morningstar or Lipper or any of the services that track mutual funds, is the variability of that alpha. So one year they made 5%, and then they went 3 or 4 years minus 1% to the benchmark, right? But that 1 year with the 5 or even higher, maybe 10%, was their lucky outcome. And even though they had multiple years after that earning what they should earn, which is below market returns, it appears that they had 6 years of great performance when it was really just 1 year, and in fact, might have been 1 month, okay? They rolled the dice, they got lucky once, and maybe they placed a big bet. That then lasts for many years, and it appears that they did really well over a long period, but it was only a short period. And to develop a set of charts that show the year-by-year excess return is so illuminating that you should see it. Literally blows the minds of prospective investors with our firm, or pretty much anybody. We do a 20-year chart that often shows one big year of maybe 50, 60% over their benchmark, and the rest of the period, they were flat or just a little bit above or below the benchmark return. So that is a statistical significance test that looks at how much there is excess return, how much variation, and then the last thing is how large is your sample? how many years of data did you consider, or data samples? It could be months, it could be years, whatever. It's the sample size. And these are just standard statistical tests that hardly any investor even thinks are relevant.
But they are very relevant, aren't they?
They're very relevant. And it's the understanding of these. It's what I call the language of risk, the riskies. You have to speak this language to fully understand it. And just like legalese, if you don't know all the legal language, you probably shouldn't be representing yourself in court. Well, if you don't speak riskies, you shouldn't be representing yourself in the public markets, okay? You have to have a better understanding or hire somebody who understands these statistical principles. And I think that's probably the number one problem for people as investors, is they just want to rely on their gut, and instead of at least a reasonable knowledge of statistics.
But many people are scared of statistics, aren't they?
They are scared of statistics, and for a good reason. Politicians and many of scientists have tortured the data, if you will, and there's, what is it called? Lies, damn lies in statistics. They have used statistics to make their case in many cases, and because the individual doesn't understand the statistic, it's easier to sort of cheat with that statistical data.
Let's face it, Mark, very few financial advisors place as much emphasis on academic evidence and statistical rigor as you do. How do prospects and new clients respond when you present this data to them?
Well, first of all, I like to call my typical prospect the intellectually curious. And I attract a lot of engineers to my website because engineers want data and they understand data. They didn't have access to this. But the reason they don't have access is the brokerage industry and the financial media doesn't put any value on it. They only put value on what was yesterday's news and hopefully giving you something that would encourage you to trade. So you're not going to hear about this other than from someone like myself, who's going to educate you on the value of it in your decision making.
You mentioned that IFA tends to attract a certain type of client. I've also noticed that you tend to attract a certain type of advisor. Their approach to advice is very different from the norm.
So most of the people who I have hired worked at actively managed, investment advisor firms before. They worked at firms where the manager was picking stocks or, timing the market and all those kind of things. And so I am very aware of the transition that an advisor goes through as they leave sort of this active world and arrive in the passive world. And I do hear a lot of stories of the contrast, even in their own mental state, because they're in this relaxation mode once you accept market randomness. Once you accept that you're going to have this distribution of returns, and it's kind of like a bell-shaped curve of outcomes, and you might get something really extreme to the positive or really extreme to the negative, but they're equally likely, and they're equally unlikely to happen, okay? So it's just as likely you get a positive or a negative, and the more extreme it is, the less likely it is to occur. So the acceptance and the embracing of market randomness is sort of almost a calming effect on you. Or you could sit and meditate and just realize that it doesn't matter. So I visited the New York Stock Exchange one time, and I have a painting I did of someone sitting cross-legged in the middle of the New York Stock Exchange, refusing to trade, while everybody's trading around them, right? And you can't take pictures in there. So there was an official photographer, and I said, come here. I said, I want to go sit cross-legged right in the middle of all the trading and have you take my picture. He looked at me, he said, "Oh, I don't think we can do that." I said, "Yes, you can. You just stand here and I'm going there." And so I went and sat down, and all these traders are running around. Look at me sitting in the middle of the room. There I sat, cross-legged like this. And I said, "I'm not going to trade." It's just kind of like a whole different mindset. So that is like really comforting, to my advisors and to even my employees. When the market has huge, gyrations some days, my employees are always astounded because in their previous firm, the phone was ringing off the hook, people wanting to buy or sell or whatever, and our phones are same as they were the day before.
So Mark, as you say, as a firm, you try to keep trading to a minimum. Why, in your view, should investors generally trade as infrequently as possible?
First of all, the transactional costs and the mistakes that people make. These are the two primary reasons that people don't beat the market. They make mistakes through concentration or just mistiming. And through all these transactions, they increase their costs, which just automatically reduces their return. The costs are an automatic. The mistakes are, they come and go. But the more you trade, the more mistakes you're likely to make.
But the financial system needs active traders, doesn't it? We can't all use index funds and nothing else.
That's an age-old question for every person espousing the benefits of passive investing, okay? What if everybody becomes a passive investor? And it also deals with the function of an exchange, which is price discovery. That's what we call this. Willing buyers, willing sellers getting together, trying to establish what's the fair price to trade this security, given everything we know about the company and about the market environment today, right? You only have to worry about that when they decide to dynamite all of Las Vegas because nobody wants to gamble anymore. In other words, you don't have to worry about it. There will be the desire to predict and trade for eternity. It's in our human nature to want to make these forecasts and bet on them. So it's never going away. You might wonder what percentage we'll be left with all of the, what I'll call the intellectually curious converting over to a passive investing strategy. If I was to guess, and I saw some papers on this, you could have 80% of the world's investors as a passive investor and allow the other 20% to set the right price and work for us, and everything will be just fine. And it probably could be less than that, actually. Every day, there's a new investor who can qualify to open a Robinhood account and can start trading on their phone, which they think they're doing for free, but they're not. And so it's just not going to happen that everybody's going to all of a sudden realize that they should be a passive investor. So you don't have to worry about it.
But hope springs eternal, doesn't it? Every day we hear about investors who've made a fortune on this or that, and we're bombarded with ideas as to what to invest in next.
There you go. Yeah. And there's another fool born every day, who will show up to want to gamble in the market. And they have these hopes and that they're going to get rich quick. This is what drives, by the way, the gambling addiction, is that you can place a big bet and get really rich quickly. I call it cheating risk. You actually earn money slowly by exposing your assets to risk consistently over time. And what they're saying is, no, I could hop right in here and get a 10-bagger on my stock. I don't have to worry about the risk. That's their mentality. So it's a get rich quick, risk cheating type of investment strategy in their mind that trips them up and confuses them into thinking that's a better investment strategy for them.
What about cryptocurrencies, how do they compare with stocks as an investment?
The main reason, let me just contrast that to investing in companies, for example. The main reason companies increase in value over time is they make a profit. The profit allows them to reinvest in their firm, help it grow, even give some of that money out to shareholders and dividends. And that's why the market has a logical reason to increase in value, okay? A Bitcoin is a Bitcoin. And the only reason we see it fluctuating in value is because of some supply and demand. And at the beginning, we thought, oh, there's a limited supply. They only made, $21 million with it. So, if everybody wants it, it should go to the moon, as they call it. But now, all of a sudden, we got Ethereum, and we got Dogecoin, and we got more and more cryptocurrencies out there. And so now where's my limited supply? And so it's a fool's errand to want to invest in it for appreciation. It may not be something that's so bad to use it as a different type of currency, international currency, but that's a different principle that it might be convenient or, something like that. Other than, I think it's going to triple in value, in the next year.
I have one more question, Mark. You're now in your 70s and show no sign of losing your enthusiasm for the work you do. What is it more than anything that drives you to carry on?
My little motto is I'm here to change the way the world invests. And as crazy as that might sound, the World Wide Web provides you that opportunity. So that's why I started creating video and putting my book online. Just creating massive amounts of content. I think we might be the largest content provider in the financial services industry. And by doing so, I'm educating the public so they can improve the way they invest their money. And that's something I'm really proud of.
You should be very proud, Mark, though perhaps one day you might just invest and relax as you encourage IFA clients to do. Mark Hebner, thank you very much.
Thank you.